Market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting an outsized reaction right now. But I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines.
The US Treasury has, $2 billion worth of funding to do per annum at its current pace. It needs to roll over about $2 billion of debt every month, actually, $6 billion every quarter. So, you're just shifting the problem around.
My sense is that it's not going to change meaningfully the trajectory if it's a one-off, but until we get to see more sense of how that term premium is going to be addressed.
Some of our guests casting a skeptical eye over the new U.S. plan to ease long-term borrowing costs with expanded buybacks. Scott Bessent now becoming the most interventionist Treasury Secretary in decades. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Bessent's move helping lift Asian stocks and bonds today, with the dollar steadying after sliding to a 3-month low. The US 30-year yield easing further in Thursday's session. Hong Kong exchanges' second quarter net income beat market estimates on strong trading volumes and an IPO boom, leading some analysts to upgrade full-year earnings. We'll hear from CEO Bonnie Chan. Also ahead, oil prices gaining for a 5th day as President Trump announces measures he says are intended to crush Iran's economy. We'll get reaction from the CEO of a business with a strong focus on the Middle East, including a factory in the UAE. Shenu Agarwal of Ashok, Leyland will be joining us later this hour. Our top story today, U.S. Treasury Secretary Scott Bessent making a fresh attempt to rein in long-term borrowing costs. Just 2 weeks after releasing its planned schedule for buybacks this quarter, the Treasury Department says it's at least doubling the size of liquidity support buyback operations for securities in the 10-year to 30-year sector. Garfield Reynolds leads our markets live Asia coverage, and he joins us now. And Garv, the market's still digesting this news, which was a complete surprise.
Well, maybe it was a complete surprise. There was big inflows into the US long bond ETF, so somebody got the move right. So well done to them. But certainly for most of the world, this was a very big surprise. Huge reaction in longer dated treasuries, naturally enough, and then also, especially in the US dollar, that's, it's all adding to concerns about, the US's willingness to intervene in some of the world's biggest markets. That's why you saw gold take off the way it took off. But also it confirms that the US government is quite happy with a weaker dollar and is not at all happy with high yields, so it's willing to take steps to bring those down, at least on a tactical basis. So yes, that sent shockwaves across the world globally, and looking at what's going on in Asian markets today, very big moves in 30-year debt in Japan, in Indonesia, their dollar bonds, also Philippines dollar bonds. So that's natural and mostly pretty much in line with what went on with US government debt, which also, of course, raises the potential that if the impact of intervention unwinds going forward at all, we could also see those unwinds hitting debt here in Asia.
Garth, we're seeing big moves here in Asia, as you said, but there's a lack of clarity. Does the move suggest stability in the markets, or is this, a reflection of deeper liquidity concerns?
Well, liquidity concerns definitely played a role, right at the heart of the matter in the Treasury market. We are, of course, in the summer doldrums. Traditionally, August, the middle of towards the end of the Northern Hemisphere summer, that's when the liquidity drains away across markets, and there had been plenty of that. So coming, with that being the case, and we had a range of headwinds for global debt markets that helped to exacerbate the moves potentially, that also, it would seem, helped to spur the US Treasury's decision to, just a couple of weeks after they'd said what their buybacks were going to be, to double the buybacks out towards the long end. And to some extent, of course, that thin liquidity helps to boost the impact of what they're doing. They would also argue that what they're doing will help to assuage that lack of liquidity. And then once you get through August, once you get into the spring, you get people back from holidays, you get money being put back to work on a broader basis, that would resolve those concerns about liquidity.
Garth, thank you so much for that. Garfield Reynolds, he leads Bloomberg M Live Asia coverage. Let's get perspective. Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Nancy, good to have you with us. I mean, the concern in the bond market is debt. We're talking $40 trillion in debt. This buyback is a Band-Aid, not a panacea.
Yeah, Haslinda, thanks so much for having me. I think one of the things that the bond market is still grappling with is a lack of guidance from the Fed. Now, I grew up in the business in the 80s and 90s, and there was no guidance from the Fed. So we have to, I think, step away and say, is a 4.7% 10-year a problem? The answer is probably no. If you look at the 90s, where we averaged above 6%, and what the Treasury is trying to do is bring the rate back down. Use their influence to lower interest rates. We'll see. I think the bond market always has the last word, and they will continue to push back.
Do you think this will provide more stability in the markets? Because we're also hearing from Bessent that he's willing to take further action.
I do. I think, he's trying to counter the bond market's response to Fed Chairman Warsh. And as someone who has been in this business for over 40 years, I don't think what Warsh is saying is particularly controversial. Bond traders do, because it makes their job more difficult. But that is the job of the capital markets, to assess risk and growth. So I think what Bessent is trying to do is sort of put in place some stability, if you will, in the markets. Now, whether it works or not, as you rightly point out, $40 trillion in debt should get the attention of someone in Congress. But it so far hasn't, because we've been able to issue the debt and to fund it. And then we've got this sort of willing and insatiable demand from pension plans and insurance companies that does not seem to abate, so for credit. So I think there's a lot of cross currents that need to ultimately come to a calm.
Yeah, I don't know. It's probably the right expression. Nancy, I mean, when you take a look at the asset classes, they're all up. Is that the right reaction, you think?
I do, Haslinda. The economy in the U.S. is growing pretty robustly. If you look at nominal GDP, we're in the 6, 7, 8% range. So even after, and this is a pretty big economy, $24 trillion. So earnings growth has been spectacular. Guidance has been increased at the highest level since 2020. And then before that, the highest level in history. Margins are improving. A lot of this goes to the impact of AI on companies' ability to produce more with less. And so we think it can continue because the economy is so healthy at these levels, and so is the consumer, despite what you hear.
So the recent sell-off, the recent rout in chips is an opportunity to buy, if you take a look at how earnings have been soaring and margins have been rising as well.
I think so. I mean, the issue with the chip stocks is, yes, they're cyclical. That has not changed, but the ability to bring on capacity takes years, and the demand has been pretty robust. Many of these companies have backlogs that most companies would, drool over, and then you've got the memory chips. So I think this continues. There will be volatility because the shorts are constantly challenging the trade, as are the hedge funds. But if you look at the fundamentals, these are not expensive stocks. NVIDIA at 16, 17 times earnings, Micron at 8, 9 times earnings, with really solid earnings growth that really can't be challenged, at least not yet.
That explains why you still like NVIDIA, Nancy. I mean, some say it's trading at a 50% discount. So for those who have, released their holdings of NVIDIA, it's actually time to dip back into the stock.
Well, we've owned it in our growth strategy, Haslinda, for a long time, but we added it to our value strategy because the stock really is trading at value stock valuations, and the earnings growth is not subsiding, nor is the demand. So, you hear a lot of people talk about the chips that Amazon is making, that Google are putting forward, but these are not going to solve the problems that, for example, SpaceX is trying to solve. So I think you want to buy this stock. It's run up recently, but when it comes in, certainly below $200 a share, you want to take advantage. And then I think you want to look at some of the other names, like Broadcom, for example, is another name. We used to call it the poor man's NVIDIA. We've owned it for 7, 8, 9 years, long before the AI story. These names are going to be part of the future. Everything that we use as consumers pretty much includes a semiconductor chip.
Nancy, another name that you like is Palantir. I mean, we've seen blowout earnings from this company. Can those numbers be sustained?
Yes. So this is not a valuation play. This is a narrative play. This is a company that is really taking center stage in terms of large language models, how they are stealing data from other software providers. They are building an engine that's going to go in the front of their software. They have demand from the U.S., of course, and U.S. Military, as well as U.S. corporate. And now they're seeing increased demand from sovereigns around the world. So I think you can, there's room in this stock for some time, but you are not buying it because it's cheap. You're buying it because of the future story.
And Nancy, one of the themes out there is actually commodities. We've seen big moves from gold. In fact, gold up about 3% on the back of that Treasury move. I'm just wondering if you see further upside. What do you do with gold? Some say that perhaps, I mean, as a diversifier, they're holding more gold in their portfolio right now.
Yeah, gold's a tricky one because it rallied when it probably shouldn't have in terms of economic slowdown or growth. I mean, we were still seeing earnings growth and economic growth, and then it stalled out subsequently. We have actually been putting our focus on copper. And the reason for that is that there is not an additional influx of money going to mining, but the demand for copper is actually industrial and AI driven. So there are fundamental reasons to own copper. Gold is a hedge, as you know, against inflation, against recession. And it's just a harder metric for us because there's no driver right now. There's no catalyst to own it. And yet it has rallied recently. So I think if you own it, you hold on, but you look around for other commodities that are driving the way that the new technologies that are going to change the way we live.
It is interesting to see how copper has diverged from gold. Do you see that divergence persisting? Is there a reason for it to be the case?
Yeah, I do, Haslinda. I think it's because the industrial demand for the metal is huge, and there is no more capacity coming online, at least not in the near future. And that is similar to what you see with, for example, Micron. I mean, these are long lead times that are not easily, you can't create supply in either one of these situations. So I think copper, you could look at it through Southern Copper, through Freeport-McMoRan, through even Teck Resources. These are companies that are, in the business of producing and delivering copper. And I think that that demand is going to increase, not decrease, in the coming years.
Nancy, before we let you go, I have to ask about Trump. I mean, what's a conversation without mentioning the president? He has talked about imposing economic sanctions on Iran, also taking action against countries which help Iran in this Iran war. Is there a trade out there for this?
The announcements, Haslinda, I mean, we both kind of chuckled when you brought that up. They change at head snapping at speed. So I would say no. I mean, we own the defense companies, and that has been a good trade until it wasn't, when you would have expected it to be. So I think what you want to do as an investor is buy companies where you see the earnings growth and you see the management teams pivoting in the right direction. So I wouldn't try to chase this administration's announcements, because they change overnight and within the same day. So buy fundamentals.
Nancy, always a pleasure to have you on the show. Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Up next on Inside, Hong Kong Exchange posts record second quarter earnings thanks to robust trading volumes and a jump in IPOs. We'll hear from CEO Bonnie Chan about what's next for Hong Kong's capital markets. Welcome back. You're watching Insight. Hong Kong's stock exchange has reported a 21% rise in second quarter net income, fueled by robust trading volumes and a jump in IPOs. CEO Bonnie Chan told us more about their listing pipeline and the perceived competition between HKEX and mainland Chinese exchanges.
Is there competition, right, between HKEX and the few stock exchanges on the Chinese mainland? I actually see our relationship quite differently. It's complementary. Well, on the face, it seems that we're competing, right? And that's probably based on the assumption that, a company can only IPO once in their life. However, I think you have picked it up in many of your previous reports. There is a growing trend of companies getting listed on both the Hong Kong market as well as the Asia market. Now, some of them have chosen to do A share listing first and then come to Hong Kong for an H share. Others have done H share listing and then return to the Chinese mainland for the A share. I think regardless of whether, how companies want to sequence it, what they are pursuing, when they want to, when they decided to list on both markets, is really expanding their shareholder base.
You launched the HKEX Tech 100 Index last year, but less than a year on, you're looking at making some adjustments.
Correct.
Could you tell us more about these adjustments and why you're making them?
Right. Well, first of all, let me tell you about our index business and why we're doing it. We certainly think that as more focus are turning back to our market, there is a very strong demand from the investors to want to get access to these indices so that they can have better benchmarking and referencing, and therefore, first of all, we do believe that Hong Kong as a market certainly will benefit from a bigger variety of indices, and therefore, given how close we are to the market, we do believe that we are in a very unique position to develop our indices.
How do you differentiate from the existing benchmarks like the Hang Seng, though?
Oh, well, it's quite different, I would say. So the name suggests it's HKEX Tech 100 index, right? So the underlying is 100 stocks. And we deliberately make it in a way so that it's more diverse, which we believe is more representative of the makeup of our market now.
I know you've hit back against this criticism of over-concentration of Chinese companies listing here, but is the exchange doing more to attract non-Chinese companies to list here?
Absolutely. A lot of the companies, especially in the Asian region, they because of the constant need for accessing the capital markets to support their growth, they quite like the fact that they can access Hong Kong, which has obviously a deeper liquidity pool. And so, for companies which might have outgrown their domestic market, having another listing in Hong Kong is very, very attractive. Now, in our pipeline, we actually have close to 10 companies, which are what we call international companies, and they are applying for a listing in Hong Kong from various regions, not only Asia and Central Asia. I also want to emphasize the fact that we are forging a lot of collaboration with regional exchanges. As you know, I have recently been to Malaysia. With Bessent Malaysia, we signed an MOU with them in March this year. And we recently recognized them as a recognized stock exchange, therefore making companies listed on Bessent Malaysia easier to come to Hong Kong for a secondary listing. And this follows a very long string of other activities that I've been pursuing. But I do think that you should expect to hear more about our progress, in terms of attracting non-Chinese companies to list on our exchange.
It sounds like a lot of focus is on Asia. Are you also targeting other regions like the Middle East or other parts of the world?
Yeah, absolutely. But the reason that you hear me talk more about Asia is frankly because of the point I referred to earlier, which is the fact that it seems to me that international investors on the whole are getting more focused on Asia.
Are you going to cancel the lunch break?
Lunch break. Okay, so
and extend trading hours. Everybody wants to know that.
All right, so I get asked that question a lot as well, extension of trading hours. So first of all, I would generalize it to say that investors want better access. Accessibility is what investors want. And with technology, right? Yes, certainly, you want to take your mobile phone out and be able to trade whenever you want to. So as a general theme, we certainly will be working on a lot of initiatives to improve accessibility. That is something we'll do for sure. Now, with trading hours, each market is slightly different. We have our uniqueness. What we think we will do, and you have shared with the market before, we will start with the derivative market, which in fact, we now trade until 3 a.m. in the morning already. But that we see good potential to extend it so that we can overlap with the opening of the US hour. And therefore, I think in the first phase, you should expect to hear from us the extension of trading hours on the derivative side.
HKEX CEO Bonnie Chan speaking with our very own China correspondent Min Min Lo in Hong Kong. Still to come, India overtakes Indonesia as Asia's least favored equity market in Bank of America's latest fund manager survey. We'll look at what's driving the shift in sentiment and where investors are putting their money instead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. And here's a quick check at where markets stand as mainland Chinese markets head to lunch and Japan comes back online. Generally, a risk on sentiment after Treasury's surprising decision to buy back long end bonds. You take a look at where Asian yields are. They are trending lower across the board, pretty much tracking how Treasuries acted overnight. And in terms of Asian FX, also getting a lift from that weaker dollar, which seems to be stabilizing right now. The yen, though, is an outlier, trading at about 158 to the greenback. Still, even as we see gains pretty much across the board here in Asia, investors are unsure whether the Treasury move stabilizes the market or signals deeper liquidity concerns. So a bit of trepidation as traders digest the news that we heard from the Treasury. Flip the board, take a look at where the Indian assets are at this point in time as they set off the trading day. We have the dollar currently lower versus the Indian rupee gaining from that weaker dollar. 95.56 is the level we're looking at. In terms of the bond market in India, we're seeing Similar reaction from the rest of the region. Indian bonds are gaining somewhat as we speak. Of course, when it comes to the rupee, though, it has been under a lot of pressure, having dropped 3 days in a row, and we're seeing a reversal right now, currently up by 0.2%. And India has overtaken Indonesia as Asia's least favored equity market in Bank of America's latest fund managers survey. Let's get to Mumbai and equities reporter Chiranjeevi Chakraborty for more on the findings. And CJ, this is rather surprising to me. What are the primary reasons cited by fund managers for India's least preferred status?
Hey, thanks, Has. Yeah, the primary reasons are the well-known ones, which include the lack of AI play. As we know, even earlier this year, Indian markets saw a massive exodus from foreign investors thanks to their lack of exposure to the artificial intelligence trade, which, as we know, has been benefiting a lot of the North Asian equities market. And at the same time, weaker growth also emerged as the second top reason for investors to sort of stay out of India. Interestingly, the new thing that we learned in that survey is that lack of reforms is also emerging as a key concern among investors. Let's not forget, Prime Minister Narendra Modi is now in his third term, and it seems that the lack of reform momentum in the economy is now a concern, an active concern for investors when it comes to the Indian stock market.
So what's the outlook for the market heading into year-end? Might we see a reversal?
Well, Indian equities have started to actually do quite well if you look at the past 6 weeks, and that's thanks to the return or tiptoeing of foreign investors back into the market. If you just look at the last 6 weeks, more than $4 billion have flown into equities, allowing markets to rise about 4 to 5%. But at the same time, the return of global oil prices to above $90 per barrel is emerging as a key concern. With the Iran war situation still in a stalemate, the outlook still remains quite subdued. It's not something as gung-ho as one would expect if you go and look at the earnings performance in the first quarter, where Nifty profits rose by about 18% from last year, the best performance in almost 10 quarters.
CJ, even as we talk about the weak sentiment, we're seeing a pickup in foreign investor flows. That seems to be a bit of a contradiction here. I mean, how do we explain the situation?
It is a little baffling, because if you go back, to last year when foreign outflows were really accelerating, one of the key reasons that was being cited by fund managers to us was the lack of earnings growth. But if you now zoom into the first quarter earnings growth momentum is really picking up, even for large cap companies which had been lagging behind previously. And that is what is bringing back interest from some of the global funds as of now. It still is anybody's guess if this momentum will continue, especially with oil prices going back up on a higher trajectory again. But at least for the bulls on the Indian stock market, it is comforting to see the foreign flow number changing into green rather than red as it has been over the past couple of years.
We shall see. CJ, thank you. Bloomberg's Chiranjeevi Chakraborty from Mumbai. Now, the US remains India's largest export market despite a year of Trump tariffs and New Delhi's efforts to diversify trade through new agreements with the UK, European Union, Oman, and New Zealand. Trade reporter Shruti Shrivastava joins us with more from Delhi. Shruti, what do the export numbers show in terms of the U.S. importance and the need for a trade deal, not just with the U.S., but other markets as well?
So the trade numbers, Haslinda, actually, as you said, that the U.S. market remains one of the most important market for Indian exporters. And the trade numbers clearly demonstrate that, if we look at the number through the last year, or even if we look at the number for this year, the financial year, which began in April, we see that U.S. has clearly remained the number one.
I think we may have just lost Shruti. We'll follow up with Shruti slightly later. Of course, Shruti's economy, trade, and investigating agencies. It seems that Shruti's back. Shruti, do we have you?
Can you hear me now?
Yes, you're back, Shruti.
Great. So as I was saying that, US remains one of the most lucrative market for Indian exporters. And we have seen that the data clearly shows that almost 1/5 of India's total exports are shipped by Indian exporters to the American market. And the American market remains lucrative because of the fact that the sheer scale of demand from the American market and the paying capacity of consumers there, Indian exporters find that irresistible, as we can see through the data. Though they have tried to diversify to other regions in Latin America, in Africa, or in the Middle East. But by far, the US continues to maintain its spot as #1 exporting market, despite the last year's tariff upheaval that we saw. And despite the tensions in the India-US bilateral relationship, we saw that Indian exporters continued to ship through the year, and Indian government also continued to push for a trade deal, securing a trade deal and bringing down those punishingly high 50% tariffs. And this back and forth, it actually paid off when we saw that India and US secured a deal, the first tranche of the trade deal in February this year.
That's right. Talk to us about this US-India trade negotiations. It's been going on for quite some time, and that framework secured in February this year, where does it go from here?
So see, the first thing that the framework deal, which was secured in February this year, the first thing it did was bring down the tariffs from 50% to 18% then. But after that, we have seen a lot of developments, in the US, the tariff regime, and whatever actions have been taken by the US post that. So while India and the US, they both have maintained that almost all the work has been, done and concluded in the trade talks. But India has also maintained that it's not going to sign off on a deal till it gets clarity on what the exact tariff regime is going to be in the US. And the Section 301 probes, which were initiated by the US, that have also sort of led to the delay in signing of the deal. So we have to see, what basically happens on the US tariff structure side and what decision Indian government takes accordingly.
Shruti, thank you. Bloomberg reporter focusing on economy, trade and investigating agencies, Shruti Srivastava. In other news, the founder of Indian pharma giant Biocon says the company will be in good hands with her niece appointed as her successor. For the latest edition of Latitude, I spoke exclusively with Biocon executive chairperson Kiran Mazumdar-Shaw. Here's a preview.
I've been thinking about succession for a long time, I'm 73 today, so even when I was entering my 60s, I said, I better think about a succession plan because, I've built something big and I want it to last. And I just felt if I really want Claire to take over from me, I need her to earn her stripes. So I actually challenged her with setting up Bicara. And she's done an outstanding job, taking Bicara to where it is. So she understands entrepreneurship. And then, of course, I have my nephew, Eric, who's an AI guru, and he can help her a lot, and he's helping me a lot, and so on and so forth. So I think I know that Biocon is going to be in safe hands.
And do you see challenges Claire would have to overcome to take Biocon to where it should be?
Look, the way I look at Claire's role is very different to mine, okay? Professionally, the company is always going to be run by professionals. Claire is going to play a board role, which is more strategic, which is more an oversight on what's happening at the ground level. But she's not doing what I've done, which is to build the company and have a hands-on operational responsibility along with a board responsibility. I want hers to be a more strategic board responsibility and doesn't have to really get involved with day-to-day operations, which I normally get involved with. So there's a bit of a distinct difference between what I'm doing today and what Claire needs to do tomorrow.
So your vision of Biocon and her vision of Biocon in the future are pretty much aligned?
I think she needs to have her own path. But she knows what I've done. She knows my dream for Biocon, and she knows that it's about affordable access, it's about making a difference to healthcare, and she knows some of those basic driving principles. So I hope she takes it in the right direction. I hope she continues with my legacy in the way she thinks fit.
And you can watch that conversation in full on the new episode of Latitude, premiering later today here on Bloomberg Television. Bloomberg.com subscribers can also watch online at any time. Up next, we'll speak with the CEO. Welcome back. You're watching Insight. Oil is advancing for a fifth day as President Trump announces a package of measures intending to crush Iran's economy. For more on Trump's latest threats against Iran, let's bring in Bloomberg managing editor Jill Deeses. And Jill, the expressions were, well, pretty aggressive. We talk about economic D-Day. We talk about economic warfare, historic measures, even isolate and defeat.
Yes, good morning, Haslinda. I think the important thing to remember with these Trump comments, though, despite, as aggressive as the rhetoric appears to be getting, is that we still don't really have a whole lot of details on what exactly this economic pressure campaign entails. And I should point out that this is something that Trump and his administration have been threatening for the better part of a week now. And we still don't know exactly what these moves look like. As I said, one thing that the United States could do is start targeting some of Iran's trading partners with secondary sanctions. That's something that Trump has kind of implied in some of his latest messages. Of course, that leaves open the question of whether or not that would extend to China, for example, which is really the primary importer of Iranian oil. And so, again, kind of opens some questions as to what exactly this pressure campaign looks like and how much that may impact some of these other trading partners.
The U.S., in a way, Jill, is also caught between a rock and a hard place, even as it wants, perhaps, to target China. The two leaders, Trump and Xi Jinping, are set to meet in the U.S. next month.
Yes, that's right. I mean, I think that also sort of makes this very, very tricky when it comes to figuring out what exactly that campaign looks like. Because of that upcoming meeting, you still have this relationship between the world's two largest economies that is, incredibly important for the U.S. and China to maintain. So, again, open question there. I do think that also the consideration when it comes to Iran is the fact that, they seem to have managed to withstand, these pressure campaigns for the past 6 months that this war has been going on. So, again, it does leave open this question of how long this can actually be sustained and whether or not anything like this would lead Iran to capitulate because, at this point, they just really haven't.
Jill, thank you. Bloomberg managing editor Jill Deeses for us out of Hong Kong. Well, few companies know the pulse of the Middle East better than Ashok Leyland, which has a 35-year legacy in the region. Its trucks and buses have powered trade, transport, and industry through various cycles of energy volatility. Let's get insights now from Ashok Leyland CEO Shenu Agarwal. Shenu, good to have you with us. You have such a huge operations in the Middle East. How are you assessing the risk and the impact from a prolonged Iran war?
Yeah, good morning. We had a substantial actually in Q1, but now it seems things have stabilized and we are back to normalcy. So our capacity is roughly 800 units a month in the plant that we have in Ras Al Khaimah, and that had taken a major hit in the month of April and May. But since June, we are seeing normalcy returning into our operations. And right now, we are actually very close to the full capacity.
So in terms of disruptions from Rai Karma, which you mentioned earlier, that's done. There's stability there as well.
We are still watching the situation, as to how it will unfold. But as of now, for last, I would say, 45 days or so, we are back to normal right now.
How do you de-risk in the Middle East while still scale your exports? What's the plan? What's the strategy?
Yeah, so I think the plan is very clear. Two things I would like to say. One is that we are running our plant on our capacity. So the demand is very robust in that whole GCC region, and therefore we need to think about expanding our capacity in that region so as to de-risk our operations into a single location. And that is why we decided last year that we would set up a new factory in Saudi Arabia, and we are progressing towards that. We are hoping that in 18 months of time we will have a new factory which will take our capacity to more than 1,600 units a month.
Is that expansion in Saudi Arabia being delayed in any way by the Iran war?
Listen, we are just beginning actually. We have not started the construction. So far, there is no impact of the Iran war. But we think that we should be able to sail through. We do not see any bottlenecks right now as far as construction of the factory is concerned. We are signing all the agreements with the government right now, taking all the necessary approvals. I think that should be done within next couple of months, and then we should start building the factory.
Shenu, you also have other partnerships in the Middle East, the likes of Qatar, Jordan, even Bahrain. Where are you with that? Are you intending to, expand it further, or are you pulling back because of what's happening there?
Oh, no. GCC is one of our home markets. We always say that it is one of the most important markets for Ashok Leyland. And the demand actually, despite the war and despite all the chaos in the last few months, the demand on the ground actually remains very robust. So we are very optimistic about this market. We are actually doubling down, as I said, by expanding into a new factory in Saudi, other than the one that we have in Ras Al Khaimah. We are very hopeful. We are very confident that this market will continue to work. There is a fundamental underlying demand there for trucks and buses of what kind we make. And we are very bullish actually in the market. And that's why we are putting a long-term bet by investing in a new factory.
Shenu, I want to touch on your recent earnings. We saw how material costs went up by about 8%. Do you see this persisting? Do you see this trending higher on the back of the prolonged Iran war?
Yeah, actually, the war has got a lot to do with the commodity prices going up. In my career, I have not seen commodity price going up so much in such a fast time, in such a short time. I do see that this impact will continue or even be a little bit worse in Q2, which is July to September quarter. But from Q3 and definitely from Q4 onwards, we see that the prices should soften down. So we do think that there is another quarter. The second quarter would be quite challenging in terms of commodity pricing.
Can you quantify how bad it might be in the second quarter and where it would be in the third and fourth?
I would say that, the commodity pricing or the material cost, let me say, as a percentage of sales would have an additional impact of maybe 100 to 200 basis points. However, saving efforts, we started a project called Achieve 2K about 2 or 3 quarters back, and that project is accelerating our savings on the material cost side. We are also looking very deeply into our other cost structures, and trying to see wherever possible. On the market side, I think we have launched some great products in last few months, because of which we think we have a little bit more ability to charge better prices. So it is a combination of those actions that will help us mitigate the impact. But yes, like I said, Q2 might have another additional impact of 100 to 200 basis points.
How much might you increase your prices to help you mitigate the rise in costs?
Listen, this phenomenon of commodity price increase has been happening since 2 quarters now. We had taken a price increase in January, then we took one in April, and then we have taken a third price increase in July. Now, we are still gauging the market. The market remains very strong. That is very good thing. I mean, you would have seen that CV industry in India has really grown very sharply since October last year, and it continues to grow. Even in July, we had a very strong market. So on the back of it, it becomes a little bit easier to take some price increases. However, we don't want to kill the market momentum, that is for sure. Yeah, so we are gauging the situation, and we will continue to try to further increase our price realizations.
Shenu, before we let you go, diesel prices, I mean, they're surging. We're seeing cracks in the market. Are you concerned about that? And what are you doing about that?
Yeah, actually, diesel availability and diesel price both were a concern, and if you look at the CV market was growing at 20% plus in India since October, but in May, the growth came down to about, let us say, 5 to 10%, right? And the major impact was from the availability of diesel, more so than the pricing of the diesel. Price of the diesel also had an impact, but I think that gets neutralized for our fleet operators when they can jack up their freight rates.
Shenu?
So right now, I think that diesel prices are quite stable. There is no issue of availability.
Shenu, we have to leave it there.
So we should
Shenu
be fine,
Agarwal,
I think.
we have to leave it there. Shenu Agarwal, MD and CEO of Ashok Leyland. Keep it here with us. This is Bloomberg.